Welcome to another episode of Beyond the Deal with Vehano Joseph. This is a show dedicated to all levels of entrepreneurs looking to scale and improve their lives. So let's dive on in with our next guest. Hello, everyone, and welcome to Behind the Deal with Vehano Joseph. And today, our special guest is Alex Kingman, the co-founder of KGI Capital. Hey, Alex.
Hi, how you doing, Vehano?
Good. Alex, I'm gonna try and give a brief intro about you, and then we're gonna dive right into your story. But here we go. KGI Capital is a real estate firm focused on multifamily acquisitions and asset management. Alex is not only an investor, but a strategic thinker who's passionate about helping others achieve financial freedom through smart real estate investments. Through KGI Capital, Alex has helped build a portfolio that delivers solid returns and insights on the market. Financing strategies and scaling are invaluable for anyone looking to grow investments. We're going to dive into Alex's journey and strategies behind her success. So, welcome, Alex, again, and tell us a little bit about you, where you're from, and your story. Listeners would love to know.
Sure. So, I am the owner of KGI Capital, and we started out in 1 to 4 unit properties, investing in those. Actually, our very first property was a house hack. So
Amazing.
it was a really good deal, actually. So we're located here in the San Francisco Bay Area, a little bit south, actually, a couple hours south. Depending on traffic. We started out here locally. We did a house hack where we rented out actually the bigger side. We lived in the smaller side, which was just a little studio granny unit with my partner, myself, and our daughter, who was 5 at the time. And we renovated it and added square footage by utilizing the garage, turned it into a 2-bedroom, 1-bathroom apartment. So it became more of a duplex. That's how we got our start. And then we liked that. So we continued to invest in smaller properties at first, 1 to 4 units. But we didn't do it in California because it's not really where investors are treated best. There's a lot of taxes and there are not great landlord-tenant laws, at least favorable for landlords. And it just adds more risk. We didn't really like what we saw there. So we decided to go out of state and do deals elsewhere where
Amazing.
we were treated better.
And where did you end up starting your out of state journey?
Like what year?
Yeah, no, which
Okay. I was like, I have to think about that. It's been a while. Yeah, we actually started in the Jacksonville, Florida market.
yeah.
And then a year later we added more of a cash flow market. It was up in South Bend, Indiana, which is northern Indiana.
Yeah.
So those were our 2 initial markets.
Amazing.
And then eventually we did move into much larger properties and multifamily as well.
Yeah. No, that's special. Just reflecting back on my journey, I was living in Miami and none of the deals made sense in Miami for cash flow and those types of things. And although it was landlord friendly, it just didn't meet my criteria for my capital. And I ended up going down to Tampa, or going up to Tampa. So, that resonates with me because that's exactly what we had to do. We had to pivot. We had to go look for where the deals made sense, and that's it's really good insight because not a lot of people, can fall into that trap, and next thing you know, you're a burnt out landlord, and you're like, oh, this is not the path, right? So
Yeah.
that's amazing. What was the aha moment from the 2 units to multi? What drove that, and tell our listeners a little bit about that.
We were doing 1 to 4 unit properties, and we had gotten to the point where we had included other investors in our deals, in our smaller deals. And so one of the reasons that we wanted to go bigger is we had more people who were interested in investing with us. So we felt that it'd make more sense from an economy of scale standpoint to be able to have more investors join each deal. And then also we wanted to just scale up and have more units under one roof because it is also, again, economy of scale mostly was the reason that we saw to move into larger properties. And then just we liked how they were valued. It's much more based on the profits and the income versus single 1 to 4 unit properties are kind of valued at whatever people feel like sometimes. So we liked that as well.
Yeah, that's a huge point, listeners. Like 1 to 4 units, don't get me wrong, I love it. I love all real estate, to be honest. Like all real estate, just any non-fiat currency based
Yeah.
asset is a good thing to have in this economy, and also for the future on a macro standpoint. But more importantly, you're limited to the upside on a single family residence because of the way we do appraisals. The appraisals in the single family is based on most caps, or the highest value on those properties are going to be the sales in that area. So you look at the sales comps, and you're not really going to exceed that too much. So it's kind of market dependent. But with commercial, with multifamily, we're blessed to have a valuation based on your NOI, and that's your income after expenses. So applying a cap rate to that, you have exponential value creation depending on where the cap rates are and what you're taking, right? So one thing that I know about Alex, because you're a student of mine,
Hmm.
you're a specialist in distressed and heavy value add. You're not playing with the light stuff.
Hmm.
You want them vacant, and you wanna turn them and do the whole shebang. Tell us a little bit more about that strategy, and why you guys love it so much.
Yeah, it's so that's definitely where we focus. And that's where we've always focused. I think just starting out how we did at first deal, we did all the work ourselves. I think the renovation to turn it into a two-bedroom costed like $20,000 because
Okay.
we did it all ourselves and added the square footage and everything. So getting our start there primed us to, I guess, move in that direction in the future. And I guess I should say, even before that, my business slash life partner is in the construction industry.
Mm,
He's a general contractor. He owns a successful business here locally.
yeah.
And so it just made sense to continue with that with our properties because we knew what we were looking at. And a lot of people who get into real estate don't know that. And so it was a niche that we could go into and dominate. So as we grew, we just stuck with the same strategy, but just bigger numbers.
Yeah. And that scale, right? It's the fundamentals of scale. Like stick to that buy box and just continuously execute. Now, obviously, sometimes you've got to pivot. So sometimes, depending on what the market's giving you, we've gone through a very crappy time in the real estate market, and it's especially in multifamily, as everyone knows, with these higher interest rates. We're just adjusting to these higher interest rates and adjusting to this marketplace, right? I think pricing is that other side of the lever that needs to come down, and we're focused on finding those nuggets. So yeah, I love the fact that you guys have stuck to that niche. It's not easy when you start off in real estate. It could be very daunting. Like a lot of us have, or either just renting, and we're now, maybe we've purchased our first home, but it's a big leap to go from an owner to an investor. Tell me, why did you guys decide to even go and start investing? Like what was that all about? Like, because not a lot of people have that mentality, right? I think a lot of people just go to work, and life happens, right? But for some reason, you guys, yeah, you picked a different path. Tell us about that.
Yeah, so good question. We're going to take it back to when I was in middle school.
Wow.
So it started there.
Love it.
um, I went on, so we had a bookshelf in our living room, and I had read, I've always loved reading. So I had read all the books on the shelf except one. We were going on a vacation where we were going to drive down to LA and stay at the beach. And so I needed a book for the drive. So I was like, well, I guess I'll read this one. And it happened to be a Robert Kiyosaki book. It wasn't Rich Dad Poor Dad. It was like, I think it had come with our cash flow game. Like it
Yes.
was just like something like that. I don't remember
Yeah.
the exact title, but basically it was Rich Dad Poor Dad. They all have the
Yeah.
same message.
Yeah.
Um, and I ended up reading that over my vacation. We were there for like a week. And so I was reading it and I was like, oh my gosh, I had so many epiphanies. And I was interested in that even at that age because I always had thought, I'd always been motivated. Like, I'm going to work hard. I'm going to, get good grades, go to college, get a good paying job, work really hard and retire early, save a lot and retire early. And that was my whole plan. But then when I read that book, my whole perspective changed. And I think when you're that young, life is a lot more simple and like black and white. So to me, it was like, I just, I'm going to do this. I'm going to do this. I'm going to do this. And I think when you're that young, life is a lot more simple and like black and white. So to me, it was like, I just, I'm going to do this. 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 I'm going I'm just going to do this now. So everything
So
shifted.
you had a shift to quadrant two, the business and the investor side of things. You were already at a young age thinking about that. Wow.
That was my plan from then on. I was like, I'm gonna be an investor. I'm gonna be a business owner, and so that changed everything for me. So throughout high school, I had different businesses here and there. Nothing crazy, but like sold candy, did actually pretty good with that, and continued to do things like that. When I got to adulthood, I worked mostly to learn different skills of business, so marketing,
Yeah.
bookkeeping, sales, different things like that. And then eventually got to the point where I was doing my own business
Yeah.
and doing real estate. And then my partner Brody, we actually met at the end of high school, and we
Oh,
are high school sweethearts technically. So
I love.
yeah, so and he didn't have any business or investment experience. Also, like neither side of our families really. They were all mostly just like middle class, had jobs and stuff.
Yeah.
We met, and then he didn't have a lot of knowledge about that stuff, but I think I kind of rubbed off on him a little bit. And eventually he started to get it. But before we even got to that point, we decided eventually that it was going well, the relationship was going well, and he wanted to he had three goals when he got to be an adult. He wanted to buy a motorcycle, buy a car, and buy a house. And first I thought like, maybe you should buy the in that order. Okay. So I was like, maybe you should buy the car first. But no, so he did it. He wanted to do it in that order. And I was like, okay, well, that's fine.
That's so funny because I did the same dang
What
thing.
did you?
It
Maybe
must
it's
be
a
a
guy thing.
man thing. It's a guy thing for sure. I bought the
Yeah.
motorcycle and then the car. Well, I had the car. I bought the car, the motorcycle, and then I met my now wife. And guys, you got to have a good woman in your corner because behind every successful man, there's a successful woman telling you not to do stupid things. And yeah, oh yeah, okay,
Yep.
yeah, on the same page. Yep.
Yeah. So yeah, I was like, okay. And I was like, okay, well, that sounds good. You're gonna buy the car, the motorcycle, whatever. But if we're gonna buy a house, I'm not buying anything that like I'm only buying a house if it's an investment. And he was like, okay, like he just wanted a house. And so we went and we were like, okay, so it looks like a house hack would be the best for us. We spent a lot of actually I think it was a couple years kind of listening to
Yeah.
Bigger Pockets podcasts and
Yeah.
learning about real estate investment and saving up for a house at the same time and all that. And eventually we got to the point where we could go and start looking. And you'd be surprised. A lot of your followers may or may not know this, but there are a lot of programs out there, especially for first time home buyers. If you go with like a house hack kind of strategy for your first property, you'd be surprised you can get into a property for not very much money, and you can still make the numbers work if you're analyzing and doing the numbers, you can find something that will work.
Well, something you just said sparked a thought. Like, you guys didn't jump in. You took the time to figure it out. I don't know how long that period was, but it sounded like you went through and really analyzed what was the best strategy. Curious, is that always how you've been? Are you a analyzer type personality, or yeah, that where did that come from? Because a lot of people make stupid mistakes and they just dive into stuff, right? Especially men, like that's which is right. And especially when you're younger and you don't have like the family and all that, it's a lot easier, but to
Hmm.
have the foresight and real just fortitude to be like, okay, well, we need to think about this, save up for to execute the strategy. Yeah, that's pretty commendable for a young person. Yeah, love that.
Thanks. Yeah, it was.
Where did that come from? Was that
So I don't know that I'm super analytical, but
okay?
I would say that I'm pretty conservative when it comes to like doing any investment. Actually, I've been told that I'm a little too conservative sometimes, and it's like kind of kills deals.
Yeah,
But I'd rather have, something. I'd rather wait for a good one.
in this market.
Yeah, especially in this market. But yeah, no, I'm really good at just kind of starting things and figuring them out. But this one, I think, since it was really, I think we just had no idea how to do it. So we were like, well, let's go find some ways, some information about people who have done it before, and let's go learn about it before so we figure out how to do it. And so finding bigger pockets was good. I've always liked books, so reading books about
Yeah, I see.
investing in real estate, stuff like that was really helpful. And so we kind of just fell into it and then found that house hack strategy and found, in our area, you can get a first time home buyer's loan. They'll give you a grant. I think we put like 3% down. And so I think we only put like $18,000 out the door to get into this $500,000 property
Yeah,
at 20 years old.
amazing.
We still laugh like, can't believe somebody gave us that money at 20. But hey, we had the income
So
to show.
really,
And
it's Uncle Sam. It's those the FHA programs, right? So
yeah,
it wasn't.
no, it was not an FHA program, but it
Oh,
was similar.
okay. Yeah, so for the listeners out there today, you can actually get an FHA program that they redefined the rules. I think it was at the end of 23 in December, where they just Urban Housing Development HUD redefined or aligned their definition of 1 to 4 units as multi, so therefore allowing more collateral. So on the FHA program now, you can, as long as you live in on one side and rent out the other side, you can qualify for a higher leverage loan. Because they recognize that, look, you're gonna live in there, so that's your primary residence. And then
Hmm.
from a risk standpoint, you also have other income from your tenants. What a beautiful way to make cash flow and build wealth while you're living there. So you have your tenant paying your mortgage. And in the future, once you guys move out there, you can rent out the other side. So now you've got two tenants paying for your mortgage, which is a beautiful thing. So great, good on you for doing that. Good on you. Okay. Yeah, where do we go from here? I guess, what has been some of the challenges scaling, would you say, that you've come into? I know you said you're pretty conservative with your underwriting, but yeah, let's talk about some of the struggles you've had in scaling, and what are you doing to get around that?
Yeah. So the first struggle we had was, I guess, when we first started, was just pretty much just like paying down our, I guess it was like when you start something new, you have no idea really what you're doing. So the very first struggle of scaling was just learning those like newbie mistakes and just going through them. And luckily, all the deals that we did, they had solid fundamentals. They were good deals,
Yeah,
which was good because we made a lot of mistakes. So the first, that was the first kind of, I guess, step, was just getting through the learning curves and making those mistakes, losing money,
yeah, yeah.
you know.
It's part of it.
But
Yeah,
after that, and we moved into the multifamily space once we kind of had that figured out. And at that point, our struggle was, um we found a good deal, but we didn't have um a ton of investors because we didn't have a huge track record in multifamily. We had a big track record in smaller properties. And so the next, I guess, bottleneck for us was um, to make sure to build out our investor base and have some investors so that we could continue to do multifamily deals.
yeah, yeah,
Because originally with the smaller properties, it was mainly family and friends and people that we knew well that were interested in investing with us. And we had, after learning, we had some good results and everything. And all those properties now they're doing well, and they will make a profit upon sale and all that.
yeah, yeah,
But yeah, so I think the last few years, the constraints have been different in growing as we continue to grow and move forward. Some things now would be, for example, in the last, we've been doing this for like 7 or 8 years, and the last like 5 or 6 of those years were, you could look at maybe like 50 to 100 deals and get a deal.
yeah,
Now
yeah,
it's like 4 times that.
yeah.
So the struggle this last year or two have just been increasing our deal flow to be able to find those pretty much needles in a haystack right now, find those good deals.
Absolutely.
Yeah. So we've been
Absolutely.
doing that.
Completely understood. I mean, look, when the market's not moving, I heard a interesting stat the other day. I was having a conversation with a fellow investor. The market, just in general, in like real estate, and even in the single family market, the liquidity is frozen up. It's tied up in those houses that people that purchase houses at 2% interest or 3%, those that locked in those rates, those people would have typically 5 years later, 3 years later, they would have been on the market. Maybe their kids graduate from like life events happen, but those transactions aren't hitting the market. And I always thought about, okay, well, that's an inventory issue. But now I'm realizing, well, that's a liquidity issue too, because that person doesn't have that cash to go buy the next house. And
Yeah.
that's slowing our market down tremendously. So, I mean, look at you, you really got to look at your deals now and the numbers and yeah, I concur with that. That's really the same thing we've been saying.
Hmm.
What about market strategies have you been applying, like looking at new and emerging markets? Is there anything exciting you could see on the real estate space or things that you've learned?
Yeah, I mean, I think overall, in general, I think it's a really good time to be looking for deals to acquire now, because well, a lot of people are sitting on the sidelines, operators, and also some passive investors as well. But there are a lot of people who have a lot of money and are looking for a deal, and they just can't find one, or don't have the systems. And so, if you are able to find a deal right now, a lot of people are also looking, so there's that, and you can utilize that or partner or whatever if you want. But also too, based on everything that I see right now, it looks like things will look better in the future than worse, most likely. And so buying now, if interest rates do come down, that has a big effect on how much you can your debt for and how much you can sell for eventually. And so if you're able to buy now, I think you set yourself up well for later. So just overall as a market, I think, I see that. Otherwise, we try to focus on looking at deals in markets that have a very large amount of like population and
Hmm.
jobs and what's the word?
So
A very
growth, right?
varied
Like growth.
employers.
Yeah, employment base,
Yeah, so not just like
diverse.
one, there's
Yeah,
not like one employer or like
yeah,
five, but 20, 30, 40 that are, different
absolutely.
sectors that are all there. So those areas have been growing, and so we try to focus our time in those areas. I think that the tertiary markets that are further out that aren't as affected by those large metros are seem to be struggling a little bit more. Not all of them, but at
Mm.
least some of the ones that we are looking at, they seem to be struggling a little bit more, especially with occupancy, while rents have gone down and debt's kind of gone up or insurance has gone up. So
Yeah,
expenses have gone up, income has gone down, and so if you're not really good at operating those deals and it's a bit of timing for even the best operators, some of them are not really doing so well right now.
yeah.
Everyone's
It
hurting a little bit.
certainly it certainly is a tough time. I definitely agree with you there. I think seeing the squeeze, right? It's literally a squeeze on
Yeah,
everything.
everyone's squeezed.
Our prices are up, our costs are up. There's nothing you can do about it. Insurance has been a killer. Insurance has been something that just baffles the mind because it's so late to the game, right? Like the inflation was like two
Yeah,
years ago, but they're still because they have to wait for the renewals of the policies, right? So they're like, hey, I want my cake too, right? You all can enjoy the upside. We, from a cost standpoint, it's just been very high. Labor went up at a good clip, and materials, right? So yeah, we're fighting that on all fronts. And then the thing that most people don't understand is the consumers hurt. Well, I guess everybody understands, but everything at the groceries costs more, the fuel costs more, every your living costs are significantly higher than it used to be. So that impacts us as investors, um, because our tenants can't pay that rent. Potentially the higher rent that we are expecting because we've either we've put in the premium by adding the value or we haven't. So yeah, it's tough all around, and we obviously wish everyone success, but that's just the part of real estate, right? There's of investing, really, it's risk, and sometimes there's just market factors that it is what it is. So getting back to market factors versus things out of your control, what are the like interest rates? It sounds like your strategy for finding heavy value add is actually it's probably in your favor, right? Because maybe you could talk to it, but buying something at a lower cost basis and then even adding a good amount of capital to get it back to operating and then leasing it up, you can handle a lot more of the fluctuations in the rents, I would imagine.
Yeah, so that's definitely part of it. I mean, I think that our strategy is really good for right now because while there aren't necessarily a lot of properties that need a physical lift right now, that's not necessarily the play because rents haven't been able to be raised like they were before. There are a lot of properties right now that are in distress from the interest rates going up, meaning their debt goes up and insurance going up and expenses going up.
Yeah,
uh,
it's brutal.
and operators maybe being new and maybe just not really knowing or just not, the last 5 years or so, you could be a bad operator and still look good and make money. So I think now some people are starting to have to learn some some hard lessons that maybe they didn't before. So for us, we are able to go in. A lot of those properties need a lot of physical value add as well. They just need a lot of work, a lot of
Mm,
deferred maintenance is going on. So I mean, we've been like, I don't want to say waiting because we've been looking, but we've been waiting for this time to come where these properties are getting to the point where they need to sell. They need to get out from under these properties, or I'm sorry, the operators and the owners, and that's where we can come and scoop them up.
right. Yeah.
That's been a lot of our strategy, buying, I guess, like for example, there was a property that we were looking at that we offered on, that was like 34% occupied.
Wow. Wow.
And yeah, super distressed. It was like 268 units, and um it was it had a lot of deferred maintenance, but mainly it was just really mismanaged. It was an REO property, so the bank owned it and they were trying to sell it, and
Yeah.
they don't want to manage it. So
No.
um, that would be a perfect play. And even though in that market rents were really soft, it looked as if we could just go in, and even if we had the lowest rents of everybody, and even if we had to give more concessions or do whatever, the numbers would still work
Yeah.
if
That's so
we
key,
went in there.
guys. So key. What a great strategy. And yeah, we've dug into that deal. I think it's, very I'm excited if you get it, and I hope you do because it's a beautiful thing. Let's talk about that mental shift that you're talking about 200 unit plus
Yeah.
deals that are 34% occupied. What was that like? I know we spend a lot of time in our coaching sessions, like just working through some of those mental switches that you have to go through. What's been some of those things that you have to overcome?
Yeah, I mean, at first it was definitely a big switch. So when we decided to make that switch, it was like, oh my gosh, how are people doing deals that are like 100 units or 50 units
Yeah.
when our mindset was like 1 to 4 units, right? So we weren't honestly, when we decided to go bigger into multifamily, kind of like when we first started just to get into real estate in general, we didn't really know what to do.
Yeah.
So
Yeah.
we joined some groups. We tried to get around other people who were already doing it, and we read books, which is, I
I
guess,
see.
indirectly a way to get around people who have already done it.
Yeah.
So we joined. I don't know if you're familiar, but Brian Briscoe has a TGIF Friday online meetup.
Lovely.
And I don't remember exactly how we got in touch with him, but we joined that group, and it was perfect. It was like the perfect group to just network with people. Some were newer and brand new and didn't have any experience. Some were experienced and have been doing this for 10 plus years. So basically, you just network. So you just go into these like breakout rooms and you just talk to people. So we would just talk every Friday, and that helped a lot because it was a lot of those people who had hundreds and hundreds of units, and they were, or thousands of units, and they were so casual about it, like, oh yeah, I have 3,000 units, and I do this and that, and it's like,
Yeah.
oh well, if he can do it, I can do it, So
There
it
you
was a
go.
lot of that. That helped, and then also asking them questions about how did you do that, and for how did you get started? So that helped a lot because really we had no idea. And then going and just asking people who had done it before, reading books about people who were giving advice about how to do it. That's the most straightforward way I can think of to get into anything, is ask people who've done it before.
Learn from others that have done the who have achieved the level of success that you're trying to achieve. That's so critical, and your network is your net worth, and having those people around you is going to push you to that next level, is going to help you. Even there's a funny story about the the 4 minute mile or whatever. For hundreds of years, people were like, oh, it's impossible, blah blah blah, and then in the 1900s, someone ran it, and all of a sudden, the following year, it was broken. That record was broken 5 times. It really is important to surround yourself with people that are up at that next level, because that's going to help you even just know that you can do it, because you at the end of the day you can. Everyone's just a person. It doesn't make any no one's superior or like more special. We all breathe the same air and we all have the same 24 hours. It's just how you choose to utilize that 24 hours is the key, right? And how you focus your time. So no, that's amazing. One of the things that I wanted to ask you was, I know we're kind of coming up at our time here, but I've got a couple of questions here. What is one piece of advice you'd give someone looking to scale from a few units into a larger multifamily?
I'd say a couple things. First, get around people who've done it before. Learn. That serves more than just one purpose. You get to learn and you get to kind of figure out what your path forward is. But
Mhm.
also, when you're brand new and you don't have a track record, even if you have a great track record in like smaller properties, that helps. But really, you don't have a multifamily track record yet. And that helps a lot. So, since you don't have that track record, building relationships with people who have already done it and who know how to do it and who have the experience and the track record allows you to then build potential future partnerships with those people to be able to partner with a more experienced operator to go and do some deals and build up that track record. So, yeah, I would say start there.
Great advice. Great advice. What are some of the common mistakes you see new investors make, and how can they avoid them?
Okay, this is a good one. Okay, some common mistakes. One that jumps out immediately would be property management. So, that was actually one of our mistakes, our first mistakes. When we went to Jacksonville, we had a great property manager and we didn't know how great she was until we went to our Indiana market and chose a horrible property manager.
Yeah, yeah,
Just
yeah,
terrible. Like,
yeah.
we still sometimes have things pop up that was because of that person. And so learning property management, learning how to trust but verify everything, and how to properly vet
Mm,
somebody that's going to manage your properties.
yeah.
And then if you are personally managing the properties, if you're doing larger multifamily, then you won't be personally managing it. But understanding that whoever's managing the property needs to be firm but fair with everybody, so they don't get walked on, but they're also not getting in trouble being a mean or bad person, I guess, being a jerk. So it goes both ways, because you want your residents to be happy and be able to live somewhere where they feel like they never want to leave, because they have a community there, right? And they like the people that work there, and they can all work together well. So property management is a huge one, because they will make or break your investment. The numbers might look amazing, but if they can't execute, you're not gonna have a good deal.
I've heard the saying that the property manager sets the tone at your
Yep.
community, right?
Yep.
And I've seen it with the thousands of units that we've had. The wrong leasing staff, the wrong general manager, the wrong
Mm.
regional can really set the tone for that team. And so these are the types of things that you got to learn, because you're dealing with people. You're dealing
Yeah.
with lots of people. And yeah, it can be very challenging if you have the wrong property manager. And the worst thing to do, which we've gone through, is keeping the wrong property manager on site for too long,
Yeah, that makes
because it
sense.
always comes back. Like you said, there's always some old stuff that will come back to resurface from the
Yep.
grave.
Like, oh, great, here it comes again. Yep.
You're a continuous problem solver when you're a real estate investor. At the end of the day, it's one of your most important team members, right? And I really love the fact that you highlighted there. You've got to asset manage your asset. Included in that role of asset managing, you've got to manage the property management company, right? So,
Hmm.
yeah, great advice. And I think, just to add on to what you were suggesting, I think don't try to do this by yourself. Like, get a good property manager. It's going to give you
Yeah,
bandwidth. It's going to give you
it's
bandwidth.
it's
Yeah.
very worth it.
There are good ones out there. There's so many good ones, and there are bad ones, and so you just have.
Mhm.
It's just like with everything, right? There's good people and there's bad people. It's just how life works. You just have to sift through the ones until you find the right one. And to that point, Alex, what has been your best strategy for finding the right property manager? What
Mhm.
tactics were you using to find a manager?
So one thing also, I guess it's a little bit more nuanced, is like there isn't just necessarily good and bad property managers as well. One thing that we take into consideration is what are they best at? Because they might be a great property manager for like a class A stabilized asset, and they might be terrible at heavily distressed property because that's not what they've done. That's not where their experience is. Whereas vice versa, a property manager that's really good when you're fixing a property up and improving it and getting occupancy might not be that good once it's stabilized. Like maybe that's just not their specialty. Maybe they're better when they've got to work with with the residents, keep occupancy while you fix things up, and then maybe it's somebody else after that. So we look at that, what's their background and experience and what they've managed in the past. We do a lot of trusting but verifying, so we kind of grill them quite a lot, and I think that that's expected. If they're getting upset or annoyed that you're doing that, then they're probably not a good fit.
Right, that's not a good partner, right?
Right. So we spend a lot of time going through all of that, interviewing them, talking to references, talking to other investors they work with,
That's huge. Get
verifying
get
everything.
recommended people. Don't
Yes, yeah.
just go on Google. Go find out who the great ones are through recommendations
Mhm.
from brokers, other property managers, real estate
Mhm.
agents, other investors in the area, which is
Yep.
that's the best source.
Yes. Yes.
And then go do your own due diligence on them, right? So
Yeah. Yep.
great point,
Second, third, and
great
fifth
point.
that. Second, third, and fourth that.
Yeah,
That's yeah, that 100%. All of our good property managers, all of our really good property managers were from referrals from other investors. So, one was like through a Facebook group, like, hey, who are the top property managers? This person got mentioned or this company got mentioned 3 or 4 times by different
yeah,
people. Oh, okay, same with this one. So it's like, okay, now we have a top four that we're gonna go and we're gonna grill and find
yeah,
find who we're gonna work with here. It's gonna really help your odds at finding a really good property manager and then at that point it's just finding one that's a good fit, that has the experience you need, and that is able to be honest and transparent and all that. Yeah, then it gets into the nitty gritty.
yeah. Go with your gut. Sometimes
Yeah,
that's a good
that's
way
definitely
of
part of
going
the
about.
part of the
Yeah.
equation for sure.
Check those vibes. If you don't vibe with those property managers,
They might
move
check all the
on.
boxes, but you might not have a good feeling about them. You might listen. If there's
Don't.
someone you have a good feeling about that checks the boxes,
Yeah,
they're
go
better.
for
They're
it.
better.
Amazing. Well, Alex, what's next for KGI Capital? What's on the horizon for you guys?
So we have been really focused on acquisitions this year and just finding the next deal and continuing with that. So what's next for us is continuing to build out our acquisition machine to the point where we have more deals than we could handle on our own and
Yeah,
then growing from there, of course. But
yeah,
that's where we're focused right now, is just building out our acquisitions. Looking forward, we will continue to grow in acquisitions and investors that we can work with, and also really just stay focused on that, on our strategy, and just continue to knock out as many deals as we can during this. I see it as a period of opportunity. So during this period of opportunity where there's a lot of distress, that hasn't really been the case for the last however many years with multifamily properties. So it's easier to find them right now. And you got to do more numbers to find those deals, but there are more of them right now than
yeah.
there were before.
So more offers, right?
Yeah.
You're getting
Yep.
more
Yep.
offers out. You're gonna get more deals. Love it, love it. Yeah, amazing. So tell me, Alex, where can the listeners get a hold of you? What's a good way to reach out to you? Yeah, if they want to learn more about your company and your strategy and investing with you.
Sure. So I'm on most social media platforms like LinkedIn under Alex Kingman. And then our website has a lot of information. It's investwithkgi.com. And there are other podcasts I've been on. So if you are looking for more information about investing or getting started with investing, there you could look at those podcasts as well.
Amazing.
If you're already listening to Viano's podcast. And then we also have like a sponsored due diligence guide if you're more looking to invest passively, because that's a whole nother topic.
Yeah, sure.
You got to find a good sponsor, just like you have to find a really good property manager. So we have different resources for you to learn whether you're looking to get into it active or passively.
Amazing. Well, Alex, thank you so much, and we look forward to your continued success in this game. And yeah, thank you for joining us today.
Thank you, Vehano.